Hello everyone, we are from Group 1 and we will present you about a conceptual framework. Our team members consist of myself, Elisa Dewi Rahmawati, Ainaya Alfaini, and Farah Afifah. Before we dive into the content, here's the agenda for today's presentation. We will start with the role of a conceptual framework, to the objectives of a conceptual framework. After that, we will explain about developing a conceptual framework. Then, we will explore about a critique of conceptual framework projects. Furthermore, we will discuss a conceptual framework for auditing standards. The first topic that we will discuss is the role of a conceptual framework. A conceptual framework of accounting aims to provide a structured theory of accounting. At its highest theoretical levels, it states the scope and objective of financial reporting. At the next fundamental conceptual level, it identifies and defines the qualitative characteristic of financial information, such as relevance, reliability, comparability, timeliness, and understandability, and also the basic accounting elements, such as assets, liabilities, equity, revenue, expense, and profit. At the lower operational level, the conceptual framework deals with principles and rules of recognition and measurement of the basic element and the type of information to be displayed in financial report. So, what is conceptual framework? The Financial Accounting Standard Board in 1978 defines conceptual framework as a coherent system of interrelated objectives and fundamentals that is expected to lead to consistent standards, and that prescribes the nature, function, and limits of financial accounting and reporting. Such words as coherent system and consistent indicate that the FASB advocates a theoretical and non-arbitrary framework, and the word prescribe supports a normative approach. Next, we will dive into the benefits of a conceptual framework. The conceptual framework for financial reporting is expected to provide guidance and structure to the standard setting process that will result in significant benefits to standard setters, world economies and markets, and also users of financial statements. Benefits to standard setters. The framework is expected to help standard setters to develop more consistent standards that don't contradict to each other. The framework should also help them by providing a common foundation upon which to base their opinions and justify their reasoning for such new standards. Benefits to world economies and markets. The framework was created to serve the public interest by providing information that users within capital markets can use to help them make capital lending and investing decisions. Benefits to users of financial statements. The users of financial statements should also benefit by understanding the framework because they will better understand the purpose and intent of the financial statement and the accounting elements included in them. This increased understanding should enhance users' abilities to use and trust the financial statements they analyze. The next topic is the objectives of a conceptual framework. In 1978, the FASB Statement of Financial Accounting Concept Number 1, Paragraph 34, stated the following basic objective of external financial reporting for business entities. Financial reporting should provide information that is useful to present and potential investor and creditors and other users in making rational investment, credit, and similar decisions. The objective of general-purpose financial reporting is to provide financial information about the reporting entity that is useful to access and potential investors, lenders, and other creditors to help them make various decisions, for example, providing loans, trading with equity and debt instruments. So, what financial information shall be reported? So, the entity shall present the information about its economic resources and claims, which is basically a financial position. Then, changes in economic resources and claims resulting from entity's financial performance, and from other events, while financial performance shall be reflected by the accrual accounting, so in the period when the effects of the transaction occur regardless of the related cash flows. However, information about cash flows is very important to assess management's ability to generate future cash flows. And also the information about changes in an entity's economic resources and claims resulting from events and transactions other than financial performance, such as the issue of equity instruments or distribution of cash or other assets to shareholders, is necessary to complete the picture of the total change in the entity's economic resources and claims. This information is presented in the statement of changes in equity. And lastly, the information about the use of the entity's economic resources. This information indicates how efficiently and effectively the reporting entity's management has used these resources. Next, I am going to explain about qualitative characteristics of useful financial information. The framework describes two types of characteristics for financial information to be useful: fundamental and enhancing. The first fundamental characteristic is relevance. So, relevant financial information is capable of making a difference in the decisions made by the users. The financial information is relevant when it has predictive value, confirmatory value, or both. Materiality applies, so the material information should not be omitted. And the second fundamental characteristic is faithful representation. In financial information must not only be relevant but must faithfully represent what it is to represent. So, therefore, it must be complete, natural, and free from error. Financial information shall have both fundamental characteristics. Enhancing characteristics are comparability. Comparability means the information should be comparable between different entities or time periods. The second is verifiability. Verifiability means independent and knowledgeable observers can verify the information. Timeliness means information is available in time to influence the decision of users. And understandability means the information shall classified, presented clearly and concisely. Enhancing characteristics shall be applied to the maximum possible extent. Next, I will pass on to my friend Ainaya Alfaini to share about developing a conceptual framework.
Thanks, Elisa. Now, I'm going to explain about developing a conceptual framework. The development of conceptual framework has been influenced by two key issues. The first issue is principles-based and rules-based standard setting, and the second one is information from decision-making and decision theory approach. Okay, first, I'm going to talk about principle-based standard setting. Principle-based standard setting is a standard based on conceptual framework or accounting principles which provides an accountant broad basis to follow. This standard also provides very general description of an accounting topic with very few additional requirements. The example for principle-based standard setting is IFRS. The advantage of principle-based standard settings are less complicated than rules-based standard. It is because principle-based standard settings is easier to comprehend and apply to a broad range of transactions. The next one is provide broad guidelines that can be applied to many situations. These broad guidelines provide a comprehensive basis and have the flexibility to deal with new and different situations. The next one is improve the financial statements, representational faithfulness. And the last one, allow accountant to use their professional judgment. Professionalism of financial statement would be enhanced if accountants are required to use their judgment instead of relying on the detailed rules. Principle-based standards emphasize the importance of fundamental in accounting, such as decision usefulness, fair presentation, and both concept of economic reality and professional judgment become relatively important. And the disadvantage of principle-based are, first, managers may choose treatment that don't reflect the underlying economic substance. It is because since principles would provide less specific criteria and lack clear application guidance, proving the incorrectness of CFO's assessment is relatively hard. And the second one is judgment and choice in many decisions means that comparability between financial statements can be reduced. So because principle-based guidelines is information that can be undependable or inconsistent, which leads to difficulties when a company compares its book of financial statement with those of the other companies. So, accounting standards developed using a principle-based approach must have the following characteristics. First, accounting standard based on a better and more coherent conceptual framework. 2. State clearly the objective of the standard. 3. Providing sufficient detail and structure that the standard can be implemented and applied on a consistent basis. 4. Minimize the use of exceptions from the standards. 5. Avoid the use of percentage tests that allow financial engineers to achieve technical compliance with standards while avoiding the intent of the standards. Next, I'll dive into rules-based standard settings. Rules-based standard is a set of specific rules that must be followed when preparing financial statements. These standards are more specific and provide specific guidelines such as FASB's Statement of Financial Accounting Standard or SFAS. Rules-based standards are very strict and simply requiring a strict application with limited professional judgment. The advantages of rules-based standard are increased comparability and verifiability for auditors and regulators. As a rules-based system provides more additional guidance, so it makes financial reports become more comparable and verifiable. And the second one is may reduce the opportunities for earning management or allow for specific structuring of transaction to work around the rules. For the disadvantages of rules-based are more complex than principle-based standard. It's because rules-based standard provides more additional guidance. The next one, organizations may construct transactions to avoid unfavorable reporting. Standards are likely to be incomplete or even out of date by the time they are issued. And manipulated compliance with rules make auditing more difficult. It is because rules-based accounting standards cause an enormous increase in complexity to apply in practice. The second key issue that influenced the developing a conceptual framework is information for decision making and decision theory approach. In this issue, accounting data are used for decision making or evaluative purposes. Accounting information for decision making begins with the stewardship function. Stewardship function means that stewards or managers should provide financial information to the stakeholder relating to the resources. And then the information on how managers have discharged their stewardship responsibility is used by equity holders or stakeholders to evaluate the performances of the managers and the company. Emphasis has been placed on the decision-making aspect of accounting information because of the development of decision theory. The decision theory approach to accounting is helpful in testing whether accounting achieves its objective or not. Next, I'll dive into indecision theory process. First, overall theory of accounting should serve as a standard by which accounting practice are judged for construction of the many individual accounting system. If the individual accounting system provides useful information, then the overall theory of accounting on which the system are based can be considered effective or valid. Next, prediction model of user maps the process by which the output of the individual accounting system provide input or useful information to the decision model of user. Financial information may have a wider range of users, such as investors, employees, lenders, suppliers, customer, government, etc. The IASB framework further states that users have a different information needs, some of which will not be met by accounting information. Thus, as we evaluate the output of individual accounting system, we must consider the extent to which information is useful for a range of decision makers. Decision theory process explores a situation where preparers were dissatisfied with performance measures based on accounting standard. Decision theory process provided other measures which they considered better to meet users' information needs. This is the Indonesia's development draft exposure kerangka konseptual pelaporan keuangan 2020. This KKPK is no different with IFRS because it's fully adopted a conceptual framework for financial reporting as of March 2018, and it replaced the 2016 KKPK. So these are 10 development in 2020 KKPK. 1. Management stewardship, prudence, measurement uncertainty, and identification of relevance and precise representation are stated explicitly in Chapter 1 and 2, which were not stated explicitly in KKPK 2016. 2. Additional chapters on the objective and scope of financial statement, as well as reporting entities and reporting entity boundaries, which were not previously regulated in KKPK 2016. 3. Changes in the definition of elements of financial statement, such as assets, liabilities, equity, income, and expense. 4. Additional description of current liability and guidelines that support the description which were not previously regulated in KKPK 2016. 5. Other guidelines on elements of financial statements related to rights, equity, income, expenses, executory contracts, substance of contractual rights and contractual obligation, unit of account, which were not previously regulated in KKPK 2016. 6. Recognition criteria of assets and liabilities, which were not previously regulated in KKPK 2016. The recognition of assets and liabilities, which were not previously regulated in KKPK 2016. And 8. Description of measurement basis, advantages and disadvantages of each measurement basis, and there is discussion of measurement techniques based on cash flow. 9. Factors to consider when choosing a measurement basis which were not previously regulated in KKPK 2016. 10. Description of presentation and disclosure as a means of communication, objectives and principles of presentation and disclosure, classification and aggregation, which were not previously regulated in KKPK 2016. So, these are 10 developments in KKPK 2020. Next, a critique of conceptual framework projects and conceptual framework for auditing standard will be explained by Farah.
Thank you, Naya. Okay, now we'll dive into the next topic, which is a critique of conceptual framework projects. The development of conceptual frameworks met with criticism in the United States, Australia, and elsewhere. Critical analysis will help explain the reasons why development of the framework is criticized. There are two approaches we can use for the analysis. The first one is scientific approach. To assume that the conceptual framework should be a scientific approach based on the methods used in other areas in scientific inquiry. Accounting prescriptions or observations arising from such an approach must justify their validity by recourse to logic and empiricism, or both. The second approach is a professional approach, which focuses on prescribing the best course of action through the use of professional values. Here are some specific criticism of conceptual framework from Godfrey Accounting Theory 7th edition book. First, unspecified rules and convention. Dopach and Sander consider that the definition of main elements of financial statements such as assets, liabilities, revenues, and etc. depends on unspecified rules and conventions. Second, vague definitions. The definition is not clear, so everyone's understanding is different. For example, is the definition of liabilities is so general that it is difficult to determine the position of deferred tax. And then, it doesn't address measurement issues. The recognition criterion fails to offer any guidance on the measurement problem, which is fundamentals for accountings. Lastly, framework may become an end in itself that consuming time and effort. Next is ontological and epistemological assumptions. The conceptual framework projects focus on providing information to users of financial report in an unbiased and objective manners. So, it has to be freedom from bias or neutral. Solomon explains freedom from bias as financial mapmaking. So, basically accounting is a financial mapmaking. The better the map, the more completely it represents the complex phenomena that are being mapped. This assumption is questioning whether theories forming the basis of framework can ever be neutral, independent, and free from bias. And the extension of this argument is that a conceptual framework cannot provide a completely objective means of measuring economic reality, since such a reality doesn't exist independently of accounting practices. Now, we dive into circularity reasonings. First, objective of a conceptual framework, as we have all known, that one of the objectives of a conceptual framework is to guide to the everyday practice of accountants. A superficial view of the conceptual frameworks indicates that accountants at least follow one scientific path, that concluding principles and practice from generalized theory. And then, existing frameworks typified by internal circularity. Qualitative characteristics are often stated in terms of other qualities which are non-operationalized.
Now we jump into an unscientific discipline. We are faced with questions: is accounting a science? Well, conceptual framework may have attempt to adopt the scientific approach, but this approach is questionable because accounting doesn't qualify as science to begin with. There are at least three explanations. First, STEM consider that accounting is more closely aligned to a law than to the physical science, since both accounting and legal professions deal with conflict between different user groups with varying interests and objectives. And second, accounting faces imperfect markets and involves subjectively based human decision-making process. And lastly, theoretical and empirical elements are somewhat loosely defined and applied in accounting, and it lacks a definitive scientific paradigm. Next is positive research. The main purpose of creating a conceptual framework is to provide financial information that can help users to make economic decisions. However, market research now casts doubt on the ability of published accounting data to influence share prices. And also, several accounting techniques are used to manipulate market conditions.
If the conceptual framework could ensure users receive useful information, this would serve a useful purpose. And then we have conceptual framework as a policy document. First, as the generalized body of knowledge, conceptual framework fails a number of scientific tests. Whether the framework can be considered as fully normative models for accounting practice is also a problem, as the accepted practice has been largely determined by the adoption of existing procedures that the framework seeks to legitimize. Second, theories and policies are intermingled in accounting, while the distinctions is well established in another empiric science. Economic policies, for example, are treated quite differently from economic theories. On the other hand, accounting theories always seems to be linked to policies. And lastly, conceptual framework not produced in a political vacuum, which may be resulting conceptual frameworks or may just be a reflection of a dominant group's wills. And then we have self-preservation and professional values. First, self-preservation implies the pursuit of self-interest. Gerboth considers that this sense of personal responsibility, or the sense of professionalism, is what makes accountants' decision objective. The key to objectivity lies in the values on those who practice accounting. Accounting must take its direction not from its concept or from its intellectual structure, but from its professional conduct. Then, professional values suggest idealism and altruism. Heinz argues that the ability of the accounting profession to retain legitimacy as profession will be judged by society in terms of apparent theoretical defensibility of the profession body of knowledge. The last topic is conceptual framework for auditing standards. Earliest conceptual framework that has been recognized was practiced by Mautz and Sharaf in 1961. Fundamentally, Mautz and Sharaf saw auditing not as a subdivision of accounting, but as a discipline based in logic. This led them to the conclusion that auditors are not necessarily limited to a verification of accounting information. But now, in auditing, there has been a shift away from substantive testing to the role of client business risk. And also, old-fashioned verification model has evolving to business risk auditing process in modern auditing services. So now we've come to an end of our presentation. Thank you.